25% of my portfolio is in these 9 stocks. So in today's video, it is heavily inspired by this recent podcast that Monish Pabrai has went on, My First Million. And I'm just going to clip a very small part of this interview so that you know where I'm coming from.
You should be able to explain your thesis of a stock in about 4 or 5 sentences to a 10-year-old. Okay, and if you can't do that, it's a pass. You can't sit down with a 10-year-old with an Excel spreadsheet. Okay, they're not going to like you and they're not going to be interested.
Right.
Einstein used to say there's like 4 levels of intelligence: smart, intelligent, genius, simple. Okay, the highest level of intellect is simplicity.
Right.
And the other thing about investing is that you have to have conviction. It's very difficult to have conviction if you keep needing to go back and look at your Excel model.
Right.
You need it in your head. So Buffett never needs to go anywhere. It's in his head. He knows what the dividend yield is. He knows what he paid. He knows what the yen is. He knows all of that.
Now, the entire premise of the discussion is pretty simple. You explain your thesis in 4 to 5 sentences, and you explain it simple enough so that even a 10-year-old can understand you. And just to hedge my position a little bit, maybe I can't explain it to the simplest form possible, simple enough for a 10-year-old to understand, but I'll try my very best to make sure that you are less confused before clicking into this video. So this is my current portfolio standing, and I have a total of 16 positions, including 2 ETFs, namely the VOO and the VWRA. So I definitely have some explaining to do for the other 14 companies. And usually, I think companies below 3% allocation, for myself, I don't consider them a core allocation. And on top of trying to explain my thesis as simple as possible, I actually add the biggest risk or antithesis that I think accompanies the investment. So I'm not too sure which investing legend said it, but I believe it was Charlie Munger that said that before you own the company, you better make sure that you are able to argue against your entire investment case so that you understand the risks as much as the opportunities. And if you have clicked into this video, I believe the title would already suggest that I'm currently covering the bottom 9. Which makes up roughly around 25% of my portfolio, and the top 5 will be in a separate video. So let's talk about the first company from the bottom, Nvidia. And I think the bull thesis is pretty simple and well parroted by many. And if you're invested in the markets some form or another, you probably would have already known this company. So it is probably one of, if not the most important company in this coming decade. And they're currently at the heart of this entire AI revolution, both figuratively and literally, because they are designing the chips of many of these high-end game-changing AI products. So on top of just designing the chips alone, a large part of their economic moat that fends themselves off from competitors is also the advancement and network effect created by their software called CUDA. And more importantly, I think the addressable market of this monster called artificial intelligence seems to be so huge, which also translates to the crazy infinite amount of demand for compute and of course better chips down the road. So when looking at their current numbers from Nvidia, they really exploded after ChatGPT went mainstream back in 2022. And because of this record demand, their growth, their margins, everything looked pretty much perfect. And from my own entry, they were trading at roughly around a 35 times price to earnings, which is equivalent to saying that every $1 of the share price I buy today, all things equal, ceteris paribus, we are expecting 35 years of earnings to get back their $1. But of course, not forgetting the crazy runway of growth ahead, they are expected to grow 30% in terms of their earnings per share for the next 2 years, which means that their price earnings growth is currently less than 1. And of course, on the bearish side, many investors are questioning whether we are at peak demand cycle, meaning to say that a lot of all these growth rates and margins are inflated or artificial, which will then normalize, especially after many of these demand hypes start to die down. And on another note, their customers, mainly many of these big tech companies with deep pockets, they are also designing their own chips for their own specialized use. So in essence, your customers are competing with you. And there is another issue of high level of concentration risk because their customers are mainly some of these big tech companies with very deep pockets because their chips are not cheap. And also because Nvidia is so important, maybe sometimes too important for their own good, they are caught in the crosshair of regulations and geopolitics. And more importantly, competition is also arising from their Chinese counterpart too. Semiconductor, at the end of the day, is still cyclical in nature, and demand can dry up very quickly when the economy slows down and priorities actually shift. and I hope that this explanation sums up Nvidia's bull and bear case. So before we proceed further, I think I just wanted to share this pretty cool and neat feature called Pod AI that was recently introduced onto Longbridge, which is a Singapore brokerage platform. And ever since large language models actually took off, I'm sure many of you, like me, have started using AI in your daily life. And personally, I think it's been a game changer of how I research investment ideas. So specifically talking about Pod AI, it's an AI-powered investment assistant built into the Longbridge app, giving retail investors access to research tools. So in the theme of this video, actually with Pod AI, you can ask for the bull and bear case of any stock and it will break down the key arguments instantly. And if you need a quick summary of recent company updates, Pod AI does that too. There is no need for you to dig through heaps of different information or even hop between apps. But here's the best part. You can actually keep the conversation going, treating Pod AI like a personal research analyst. Ask follow-up questions, dive deeper into their financials, or even explore the current valuations. And more importantly, for my Singapore viewers, Longbridge is currently running a very attractive sign-up promotion campaign for new users, where you can grab rewards worth up to 800 Singapore dollars. And if you open an account with my link below, you get to enjoy a lifetime $0 commission for trading US, Hong Kong, and Singapore stocks. So even at the lowest tier, all you have to do is to deposit 2,000 Singapore dollars, maintain your funds for 30 days, and to complete minimally 3 buy trades. And you get to enjoy 0.5 Nvidia shares worth roughly 65 US dollars. And because I'm a Longbridge partner exclusive, you get an additional 18 Singapore dollars cash coupon and a 6% per annum interest boost coupon. So specifically for their cash boost promotion, you get a 6% per annum for 60 days with their cash plus money market solution and an additional 6% interest boost coupon on your first 2,000 Singapore dollars. You get 12% per annum for 60 days and that's worth roughly 40 Singapore dollars. So if to qualify for all these minimum requirements, that's worth 140 Singapore dollars on your $2,000 deposit and that's roughly 7%. All you have to do is to create an account with the link below and to fulfill the minimum requirements and to collect all these rewards under the My Coupons segment in the Longbridge app itself. And this promotion will end on the end of May 2025. And thank you Longbridge for sponsoring this video. So the second company I'll talk about, I'll actually jump the gun to talk about TSMC, which is actually my 6th largest position. So TSMC's bull argument is that they, alongside Nvidia, they're going to be so consequential because they're basically the upstream manufacturer for Nvidia's chips. So Nvidia designed the chips and then they send the orders to TSMC and TSMC will manufacture them. So the whole AI demand boom story is applicable to TSM too. Specifically, they're actually the world's #1 chip maker now. So TSM, which is Taiwan Semiconductor Manufacturing Company, being in the manufacturing industry, like the name suggests, with high levels of capital expenditure and spending for reinvestment for the next cutting edge production, also means that there is high barriers to entry and they are very hard to disrupt, especially compared to the designers, which is Nvidia and AMD and the likes of them. So the decade-long relationships that they cultivated with their customers, like Apple and Nvidia, ensures that they continue to yield the demand scale and commitment proposals, keeping the loyalty of their customers. And even if today a different manufacturing company comes up trying to vie for orders from Apple and Nvidia, they really need to come up with an insane value proposal. So much so for them to switch out from this reliable manufacturing partner like TSM. Not so much about just offering a cheaper alternative than TSM. Now moving on to TSM's bear argument, I think everyone in the chip sector is subjected to the cyclical nature of the economy. And although investors remain quite hopeful for this demand explosion of this entire AI race, there is also the geopolitical dance between China, Taiwan, and US, and even more so compared to companies like Nvidia. And they also run the same few worries, specifically customer concentration in a few big customers, and they're extremely capital intensive, which might affect their future valuation multiple. And it's also not such an easy, high profit margin business that can just print cash flow on demand. So you have to weigh the pro and con. They are not easily disrupted because of the high barriers to entry and their manufacturing infrastructure. And the trade-off here for these high barriers to entry is that their margins are not as lucrative or as eye-watering compared to their designing counterparts. And looking at the numbers, I actually bought into TSM during the semiconductor down cycle when they were trading at sub 15 times PE ratio. And of course, in hindsight, when you compare it to the current rise in EPS and margin improvement, it seems like sub 10. And of course, I got in clearly at a greater deal. So growth is also expected to be in the mid-teens in the next 2 years. So I think I have nothing much to worry about unless we really do hit into this cyclical nature and demand just evaporate, and that will definitely hit both their top line and bottom line figures. So specifically for ASML, I decided to talk about their companies in this fashion, from Nvidia to TSM to ASML, because ASML makes the equipment that is sold to TSMC to make the chip for Nvidia that gives them the design and to put in the orders. So ASML is actually the closest to operating like a monopoly that can help them make the most advanced chips, which makes them the closest to selling shovels during the gold rush. Because regardless of how this entire AI story is going to play out and whether the downstream customers are able to achieve some sort of return of investment, ASML bookings are already filled to the brim. They are booked out by all these chip manufacturers. So they are already booking a lot of profits from this entire AI boom. Now, to combat the cyclical nature, they do also have the upkeep and servicing revenue and backlogs of customer order demand, putting in months and years in advance. But of course, I think the deal breaker, regardless of which part of the supply chain you are at, is that when demand wanes and we go into the down cycle, none of them are being spared. And the bear argument for ASML, similar to Nvidia, is that they are at the heart of many of these cross-border regulations and restrictions. They do have a very huge complex supply chain, which can be seen as both a pro and con. Pro because it's not easy replicable and they have high barriers to entry. And in fact, the running joke for ASML is that no one person in the company, maybe except the CEO, knows how this entire machine actually come together. And the intricacies of the machine that they produce, any hiccups can actually cause massive delays, which is on the con side. And of course, let's not discount the cyclical nature of the semiconductor industry. And I've been mentioning it for multiple times now, and some of you might be thinking, oh, no worries, AI demand will only go up. But I implore you to look at many of these companies, whether it's TSM, Nvidia or ASML, look at their past 10, 15 years track record. You can really see that cyclical nature of the stock price. So just don't discount that fact, even though I know that a lot of people or investors have made money from these three companies. So ASML, they are currently trading at a relatively rich valuation at a 29 times forward PE. But I think for a monopoly company, of course with the aforementioned risk, I think it's still pretty fair. You also need to think on a portfolio level, what's your overall percentage risk exposure to the whole sector. Right now, for these three chip-making companies, or at least in the semiconductor space, I'm currently sitting at roughly 7%. It's something I'm comfortable with, and in fact, I don't mind pushing it up to 10 to even 12%. But that's of course based on my own personal comfort level, and you have to make your own decision. Now, moving on to the fourth company, Adobe. So the bull argument for Adobe is that they are the king of creative software. Photoshop, Lightroom, Premiere Pro, you name it, they are basically the market leader. They're extremely entrenched in the entire design and creative ecosystem with very high level of switching costs, and is probably the default enterprise solution with high stickiness for any design or creative agency or outlets or divisions or departments. They have a strong track record of execution, and their transition to a subscription model allows them to have great visibility in terms of their growth. And in fact, I even made a specific video for Adobe back when they were trading at nearly $300 per share. So I think the bear argument actually revolves around the very high level of uncertainty in the direction of how the entire industry is going to progress in the short to medium term, especially when you throw the AI spanner into the picture and nobody knows how things are going to progress, especially with all the image and video generation capabilities with your AI and your large language models. Mostly, I think AI disruption risks and how they are able or unable to harness it effectively. On top of that, there is also intense competition from the democratization of content and creation, especially with Canva, which is their main competitor. But I think more so for the amateur space compared to the professional realm. And I've addressed or alleviate this concern in that particular video. I'm looking at the past and trying to predict out into the future. We really don't know if the demand is able to keep up in lockstep to continuously require Adobe's suite of products and how it will disrupt the entire industry per se. So personally, I'm still thinking quite hard on this particular company on whether I want to continuously bump up my exposure. They're currently sitting at a forward PE of roughly 20 times. Historically, they have been a high performer and a very strong adapter. I do hold the opinion that Adobe is here to stay, but the growth path ahead remains uncertain for subsequent penetration. I'm weighing the impacts on growth and relevance of how the industry will progress. And the fifth company on my list is Haidilao. So Haidilao is actually a popular Chinese hotpot chain, and my initial thesis was pretty simple. They've managed to solve the food and beverage trilemma, which is what I call location, replicability, and distribution. So specifically for location, how Haidilao tried to offset it is via their strong brand name and association to service. And their excellence of service actually offsets a small part of this location issue. Because even if the location is a little bit inconvenient, they will make their way to Haidilao because there is that brand name and association. But of course not to say that if Haidilao operates in a random island, people will still flock to that branch. I think we have to weigh that pro and con. So secondly, in terms of replicability, I think hotpot itself, there's no problem trying to replicate food experiences. In fact, I basically just throw you the ingredients and you are expected to cook on your own. The food suck, it's probably the customer's fault. But I think there is a small caveat here, which is in terms of food quality. But Haidilao has also managed to solve their supply chain by doing some sort of a vertical integration because they do own a pretty sizable stake to their upstream suppliers. Now, the last part, in terms of distribution, they are heavily reliant on their internal culture and system of grooming the next leader and outlet. So to not go too much into the details, they have a very strong rewards incentive. Some even call Haidilao some sort of a MLM structure, where they get some sort of a overriding for basically trying to create this very strong culture of promoting and developing talents internally. On the flip side, moving on to the bear arguments, I think specifically for hotpot, it's incredibly competitive. There is always a trade-off. By being easy to replicate means that there is high level of competition. So they have to differentiate. And in this case, I think Haidilao's strategy is through service excellence, not by competing on price points. But that also means that they suffer during times of economic uncertainty and as consumer belts tighten, which is what we have seen in the past few years back in China. So the underlying thesis actually still remains where the younger folks don't mind paying for higher quality experience. And their internal culture of expansion will work well as they try to scale bigger. And of course, the numbers that we are seeing now are suppressed due to the weak consumer sentiments. So currently, they are trading at 16 times PE. I don't think it's cheap or expensive, and it's really determined on how bullish you are about the company. Now, moving on to the sixth company on the list, which is Lululemon. So the bull argument for Lululemon is that they are an incredibly well-run yoga pants company. On a wider scope, they're an athleisure apparel brand. And despite being a tough industry, they've actually built up a cult-like brand following, which enables them to extract high levels of margin. So as they mature, actually growth also started to slow down. But they're hopeful in terms of their growth expansion plan, which is the next leap forward, in terms of menswear and their international expansion, which is basically also trying to replicate the current strategy that have worked so well in the Canada and US space. So for their bear arguments, I think at the very core, it's still a fashion company that might lose its relevance anytime, especially in this ever-increasing competition from companies like Alo and Gymshark crowding into the space itself. And their premium pricing also means that they're subjected to a very high degree of recession risk. If the economy is going through crunch time, I'm not too sure whether people are willing to fork out $100, $150 to buy yoga pants. But of course, there is also this counter-argument, which is the lipstick effect, where consumers will cut back on a lot of their major spending, but they still want to feel good about themselves, so they don't mind spending on lipsticks, or in this case, yoga pants. But this theory has not been stress tested yet. So international expansion is also not guaranteed, but we are currently still seeing good signs of scaling, especially in China, for now. And like I've alluded, they've executed phenomenally well in the US-Canada region, and their valuations actually show the premium that investors are willing to pay. They're currently trading at roughly 22 times PE, but how do they go from here is really dependent on whether they can replicate their successes elsewhere and to also expand their product lines to continue extracting more margins and premiums from their existing customers. Now, moving on to the seventh company on the list, which is LVMH. So by now, if you talk to any younger folk out there, they're probably aware of this brand. And it speaks volumes to the level of societal conditioning from young, especially to the middle class. So they have a strong portfolio of iconic brands, and they're really masters of serial acquisitions, and they have a best-in-class execution. So they operate in the luxury segment that allows them to flex their pricing power to a certain extent. This to a certain extent is pretty important. Moving on to the bear argument, Even though they are in the luxury segment, they are in the lower luxury segment. So pricing power might be pretty limited. So there's a trend of slowing luxury demand across the globe, especially China, and LVMH having a very big footprint in China, they are impairing their growth outlook ahead. And they are very dependent on this group of consumers on their discretionary spending. Hence, they cannot run away from the cyclicality of the broader economy. And there might be potentially some succession issue as well, which makes the outlook even more uncertain after Bernard is gone, especially I believe he's over 70 years of age today. So personally, I got into LVMH at roughly 24 times PE. I do respect the execution and the mindshare that they've managed to build up due to their cultural significance and their export of a lot of all these fashion luxury goods. So I don't think that it will necessarily be a bad investment in a longer term horizon, but you'll probably have to wait it out. Now, the 8th company on this list is Meituan. So Meituan, for those of you who don't know, is the king of food delivery in China with more than a 70+% market share. And they do have a super app status with hotel booking, travel, ticketing function all in one app. Of course, with this whole food delivery as the front and center. So the app is extremely sticky, they have high level of engagement, they have high traffic and data collection, which translates to different monetization possibility down the line. And they are basically the gatekeeper of traffic, which can make or break businesses, especially F&B businesses. So from one of the very light-hearted conversations that I had with local F&B businesses, they hate Meituan, but they can't live without them. That is basically the essence of the discussion. So looking at their tech and execution, they've been ultra competitive and they've drove out big competitors like Uber out of the market, and even Alibaba with their Ele.me alternative, they have never been able to break the market share of over 30%. And they're always on the bleeding edge tech by exploring new ways such as drones, autonomous delivery, and their supply chain optimization, to name a few. So some of the bare arguments for Meituan is that it's a highly competitive space. I don't think they have very, very high barriers to entry because any company with deep pockets can theoretically try to penetrate into the business as well, or the industry. So with JD.com, with being the new entrant in this market too. So they are currently also plagued with this problem of thin margins unless they are able to find other ways to monetize their existing base. So building on the idea of thin margins, the regulatory requirements in China is also evolving, and the need to take care of their riders' welfare like insurance will inevitably eat into their margins unless they start raising prices to consumers or merchants. So the network effects that they've created, which is the availability of merchants, being able to attract traffic and consumers' attention, and also the rider delivery network, and this is the golden triangle, could theoretically be competed away if someone has deep pockets and strong execution to deliver. And last but not least, they live and breathe in China, so when consumption and spending slows down, they'll be the first to feel the impact. And even though, despite the slowdown of the past 4 years, Meituan actually turned a profit while still expanding and scaling, probably due to the nascent industry, which also shows the level of execution and the adaptation quality the current team actually possess. But not forgetting that they are trying to expand overseas, but now to a very much smaller extent compared to their current strong foothold in the Chinese market. Now moving on to the last company on the list, which is Meta Platforms. So the bull argument for Meta is that they are the king of social media, their family of apps dominate the entire social landscape, and they command a huge chunk of all of our screen time. So they've managed to cleverly create an entire ad architecture ecosystem, which makes them an advertising machine, plus also integrating AI into both the algorithm to increase the retention on the platform, which then translates to more real estate, and on the merchant side, using AI to help harness and to serve better and relevant ads to improve conversion and also targeting, especially after the crackdown of the Apple privacy episode. So the bare argument for Meta is that Zuckerberg is still relentless in his whole VR AR pursuit, which is still a money-burning machine, and because he has super voting shares, nobody can tell him to stop. And also a bigger concern for investors that are more quantitative in nature is that are we at peak levels and margins today? So the ad industry is pretty cyclical, and companies tend to cut back spending aggressively during a tough cycle. So to a smaller extent, there is also potential regulatory concerns and also the future teens consumption habit, especially with competitors like TikTok and Snapchat, whether Meta will still be able to hold onto the mindshare. Not talking about the next 2, 3, 5 years, but more about the next 10, 15, 20 years. So personally, I did bought Meta Platforms during the lows, and I need a stronger reason or catalyst to keep adding to them to basically break the current percentage allocation, which is roughly 5% or so. And after this episode, I think here's my conclusion. I think this was a very good exercise, and I encourage all of you to at least run it through your portfolio once and to document it somewhere so that it can serve as some sort of a record for you to look back in the future as to what they've got right and what they've got wrong. And through this exercise, I think it also forces you to be intellectually consistent and not just think or feel like you've got it covered, you know the company good enough, especially by making sure that you can hold both opposing thoughts together. And even after considering the most bearish arguments, you're still comfortable buying that stock. I think that you can realize that I've gained quite a bit of clarity in terms of which stock I have quote-unquote higher conviction in, while others where I'm also being increasingly skeptical about. And in the next part, I'll zoom in a lot more into my top 5 positions, and I want to have a little bit more time to share my thought process and how I manage those positions too. And of course, don't forget to subscribe to get notified for my next video drop. And with that in mind, I'll see you in the next video, but more importantly and hopefully, I'll see you guys on the moon. Goodbye.